Hey there, everyone. Happy Tuesday, February 17th. Welcome back from a long holiday weekend here in the U.S. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny but kind of chilly Redmond, Washington. Hope you guys are all doing well. We had a good long weekend of kids soccer here in the Keller household. About an hour away, we had a tournament over 3 days. Hey, the team won, which is awesome. They won the championship for their division. That's always killer. Dealing with injuries and things like that on the team, but overall, good growing opportunities, good learning opportunities. We're trying to be safe and enjoy it as much as possible. I hope you guys had a great long weekend here. Monday, of course, the market's closed here in the U.S. as we check in on things here on Tuesday. We're coming off of a pretty tough week, and particularly Thursday and Friday of last week, major signs of distribution. Last week, we saw things like the Hindenburg Omen confirming a bearish signal for the second time in about 3 or 4 months. But breadth conditions generally remaining pretty strong. We're seeing a lot of names break down, major financials like JPMorgan breaking down. But some of those breakdown stocks testing key support. We're going to highlight today JPMorgan, also Medtronic, in the healthcare sector, testing key support. Good opportunity to kind of revisit how to approach names that have pulled back, kind of differentiating a short-term tactical pullback from something more significant. In my opinion, there's a couple things you can do to try to understand that and differentiate, and I'll use those as some examples of how to show it. Along the way, we're going to check in on market conditions. And as always, we've got 3 main parts to the show. We'll start with a recap of what happened in the markets today. We will focus on the heat map and think about how things have evolved through the course of this trading day, focusing on some particular stock and group themes. And we'll finish off looking at some charts that I've hand selected through the course of the day. As always, your questions are welcome. We had an all mailbag episode on Friday. There was a lot of fun. So can't thank you guys enough for just dropping some really fantastic questions on our YouTube channel. Please keep them coming. If anything I show you today makes you think of a question, drop it in the comments section of our YouTube channel, won't you? I would love to hear from you. Hope to answer one of your questions in our next mailbag episode set for this Friday. S&P 500, NASDAQ Composite, Dow, all not finishing too far from where we finished the week on Friday. You'll note as we look at the little preview charts, all 3 of these indexes started in a position of weakness, and the opening 30 minutes was kind of a negative move across the board for all those major indexes. But that low around 10 o'clock, 10:30 a.m. Eastern, ended up being the lows of the day, and all of these kind of rallied through the course of the day. You can see this big stepwise motion. By the end, we finished just slightly above Friday's close. So today, Tuesday's session, essentially much ado about nothing. Chopping around. Good to see some demand coming in the first hour of trading, but again, directionally, not a huge significant move. Mid caps and small caps, again, all within 0.2% of Friday's close. So again, just not a big movement day. The VIX did spike up to as much as 23 when the S&P and the NASDAQ bottomed out around 10:30 a.m. Eastern. It got down just slightly below 20, did finish still above there. So we've now had a couple sessions here where the volatility has finished above that crucial 20 level. And the more that it does that, the less confident I feel that there's going to be some dramatic recovery in these markets. Feels more like the market is back on its heels. So the VIX came down slightly, but did again remain above 20. That's our key level to watch, our red flag level, as we like to say. I had a good discussion earlier today with Gina Martin Adams. Gina's awesome. I've known Gina for a number of years, followed her work as she's gone through a number of different firms. She's now the chief market strategist of HB Wealth, and really good thoughts about macro conditions, about interest rates, about inflation, about the state of the consumer, but all of that relating to what we've observed in terms of conditions of price action and breadth and leadership rotation. Look for that latest episode of the Market Misbehavior podcast coming your way very soon. Hopefully tomorrow we'll get that out to you. Latest episode of the podcast, by the way, with Rob Hayworth. Rob's discussion was actually really interesting as well. Rob's from US Bank Asset Management. He's based here in the Seattle area. Had some really good thoughts about the economy. He's way more optimistic on the economy than others that I've interviewed, and I find that was really helpful to just hear what he was seeing and reading to make him have that sense. Great thoughts on how tariffs have kind of filtered down into inflationary measures and earnings. So I'd encourage you to check out that episode of the Market Misbehavior podcast, which came out, we just put that out actually this morning or last night recently. Good episode. All right, back to what happened today. Bonds basically mixed, right? Bonds have been rallying here over the last week. The TLT was just up slightly, the dollar up slightly. Again, nothing really had a significant move until we get to this page, which is the commodity page. Gold and silver going risk off again today. Natural gas, crude oil. So in the energy space, copper prices, all in the red today. Gold and silver both down pretty big. Silver was down about 5%. The GLD is down over 3%, which is actually a more significant move than we've seen in quite some time. Chart of gold is super volatile, right? If you look a couple months ago and look at like the third, fourth quarter of 2025, completely different picture. It's almost a completely different asset class to what we're seeing here in 2026 with a lot of volatility, sort of that exponential rise, that sudden decline. And now we're kind of chopping around. This is the way I think of the chart of gold and silver, kind of backing and filling, right? You have this big spike higher, exponential rise, big drop, very, very sudden. Then we've been sort of filling in that range between the all-time high and that first major pull down. We haven't had that next big leg lower, which is why for me on the GLD, watching like the 50-day moving average, good way of just differentiating, is this still okay? I think the chart's still okay. A couple more days like today, though, we start breaking key support levels. That would be a cause for concern. Bitcoin really continuing to be risk off here. So in the commodity space and in the crypto space, more red than green generally. Bitcoin down about 1.8%. Over the weekend, it chopped around. It did get up to around 70,000, but that was just a brief spike. We're currently trading just below 68,000, which has been the peak here during the equity trading session. So overall, that chart, I would argue, still in a primary downtrend. You can see that most of the top 10 coins tracked on the stock charts platform in the red. Looking at the 11 S&P sectors, sector leadership themes, I think, are the game here. As an equity investor, recognizing that there's opportunities outside of mega cap growth, I think is incredibly important, if not vital to your portfolio success. I've got a webcast coming up this Thursday, by the way. I'll share with you some details about that here in a few moments, but pencil that one in. We'll talk about leadership rotation and just thinking about what it means that certain sectors are doing quite well. Today, for example, financials actually in the green. Financials up 1.1%. That's the XLF. The XLF has been struggling. Big banks have been struggling. Regional banks have been struggling. Nice counter trend bounce today. Real estate, number 2, up 1%. Industrials up 0.5%. Technology ended up being flat for the day, and the rest of the Magnificent Seven sectors basically flat to slightly down, very similar to the major equity indexes. On the downside, you have consumer staples, which has been one of the stronger sectors here in February, down 1.5%. Energy and materials both down 1.1%. So today, a bit of a mean reversion in terms of financials being one of the worst sectors, if not probably the worst sector in the S&P so far year to date. At the top of the list, consumer staples, which has been one of the better places to be, pulling back a bit. And there's some really good charts in there, all kind of pulling back off of swing highs today. Looking at the breadth conditions, let's continue on here on the dashboard. I mean, about as neutral as I've seen these breadth readings. Look at this, almost identical with a couple thousand stocks, literally 48% up, 48% down. About the same for the NASDAQ composite. For the S&P, 48 to 52%. So these are all, dead neutral numbers. This is a coin flip in terms of stocks up or down. So to summarize today's session, the action was not in equities. There's plenty of movement, but in the end, breadth was neutral, price action was neutral, momentum completely neutral. The big movement was in the commodities space, with commodities moving down pretty aggressively today. Looking at the Magnificent Seven, though, some action here. Apple up 3.2%. It's been a while since I've made that sort of announcement here when we get to this particular widget on the dashboard. But Apple having a nice bounce after, last week, really good through earnings. Thursday and Friday, Apple pulled back quite a bit and today sort of regaining some of that decline. Broadcom up 2.3%. Amazon and NVIDIA both up over 1%. On the downside, Tesla down 1.6%. By the way, I have a Tesla Model 3 at home. I just scheduled mobile service. They're going to come out to my house to change, to rotate the tires, fix the wiper blades, and do a deep cleaning on the cameras. That's a new one. I went to the app to order service, and they're coming to my house. I'll report back on how that goes. Those of you that are not Tesla owners, I'm fascinated about the Tesla experience just because it's a company I've covered. It's a stock I've covered. I had the opportunity to get one, so I did. And now I'm just enjoying the experience of it. I mean, it is the most unusual car ownership experience I've ever had. Everything's different. You buy it over the app. I'm signing a lease on the app and agreeing to the terms there. I'm ordering service on the app and they're coming to the house. It's different. Is it good different? Remains to be seen. The stock down 1.6 news on the news that 1.6% on the news that Dave's getting service on his Tesla this week. I'll report back and let you know how that is, by the way. Alphabet and Microsoft both down over 1% today. So, again, even with the mega cap names, I mean, nice upswing on Apple, Broadcom up over 2%. Those are pretty good moves, but mixed otherwise. All right, let's get to the heat map and look at how things played out. And again, when we're looking at a visualization like this, I love data visualization approaches like a heat map, like we're seeing here on the market carpet on stockcharts.com. Where we're able to look sort of at a high level, literally take one big step away from your monitor or your mobile device, wherever you're watching this, and just sort of look at the general complexion, right? What stands out? What colors are bold that draw your attention? Or the intent, the purpose of a visualization like this is to help you identify important things, right? Identify actionable movements, actionable patterns, right? And so we use color to represent the significance of the move. With the benchmarks flat, the average color is netting out with the breadth neutral, right? The average color is kind of neutral, yellow to amber. So what's up a lot, what's down a lot? What are those bright green and bright red boxes? Are there clusters that represent particular groups in different sectors? That's what we want to think about. So what stands out to you as you're looking at this visualization? For me, I'll point out a couple things here. Number one, I'm actually, today kind of drawn to financials because financials have been such a tough sector in 2026. I mean, this is the relative performance of the XL, or this is the chart of the XLF. I mean, this is the relative performance of the financial sector. And, going back to the April market low, I mean, it's hard to find a sector that has struggled more on a relative basis since April of 2026 than financials. There are others out there, but particularly year to date in 2026, because financials did really well in November and December. And I remember highlighting the XLF making a new all-time high. I remember looking at charts like Goldman and JPMorgan just breaking out. It's like, all right, the sector's finally, it's working, right? The financials are working. That's not what's happened, right? It's like you flip the calendar to 2026. In January and February, this has been, I believe, the worst sector in 2026. Now, the XLF right now is testing key support. It broke the 200-day, but you see how it's holding these lows from August of last year and November of last year. I think that 51 level on the XLF is pretty important. I mean, this is in a pattern of distribution, but we're kind of at that last level that if we hold that, things are still okay. But if the XLF goes below 51, I don't think you can call this chart okay anymore, right? I think you have to call that a broken chart or a chart in distribution. So very, very, very close to that. So it strikes me that as the XLF is testing that key support, as a number of the charts represented here by these little boxes are testing support as well. Pretty decent day, and most of these names outperforming the S&P today. That's noteworthy to me. Another one would be in the upper right with consumer staples. Consumer staples has been one of the better sectors in names like ConAgra Brands, CAG. Fantastic charts. We highlighted this stock breaking above the 200-day moving average today. Big time pullback, down 4.4%. So what often happens in the technical analysis kind of body of knowledge, if you look about classic price behavior, a break above key resistance like the 200-day moving average, and then after that breakout, a pullback to test the breakout level, super common. If this chart is able to hold that 200-day and buyers come in and create this new upswing, that's kind of the classic technical pattern, right? Where you have a breakout, a pullback to retest the breakout level, and then you just kind of confirm the new uptrend phase. CAG is right at that point where Conagra Brands needs to hold this 200-day and hold this breakout. And if not, all of a sudden this is a vulnerable, if not outright broken chart. And I'm seeing that kind of pattern with a number of these food products names. A number of them have had nice runs higher. A lot of them that have been breaking out, like a TAP, for example, Molson Coors, making a higher low, so that's good. We just want to make sure that it holds that support as it pulls back. I'll let Mondelez, MDLZ in that same group, in the food products group, pulling back. So, a lot of these made new three-month highs last week, and we were focused on that. They're all pulling back here today. So let's see if that's the beginning of something further. Watch those, make sure we keep making those higher lows. Watch the momentum, right? Watch the RSI. The other thing I would say on the heat map, kind of glancing around here, is, of course, technology. Technology is always an important sector to follow. But here, for example, we've got Apple and Broadcom and NVIDIA, 3 of the top 5 weights in the XLK, all up and all dramatically outperforming the S&P today. And that's pretty encouraging. But at the same token, we have a bunch of names, particularly like a Micron, which has been one of the better charts in technology, pulling back. What's another one that's had a pretty good run? Akamai Technologies, just a pullback, right? I mean, this made a new all-time high last week. So I'm not too concerned about that chart just yet. A lot of these charts have actually not been particularly good, right? Like a PANW, AAPL, and these are stocks that have been rotating lower. CrowdStrike, these have been in downtrends for a couple months now. So just sort of continuing that distribution. So within the sector, I mean, the question is what is not going down? Apple with an up day is encouraging, right? I mean, you want to obviously find some stability and find some sort of a upward move. But other than that, just again, it's kind of confirming a sector that's coming out of favor here. Applied Materials, right? Let's give a shout out to a stock making new all-time highs today. Applied Materials is getting it done. But that's pretty rare. Most of these stocks are not making new highs today. JBL, by the way, that was one of the stocks I picked in the Super Bowly NFL style draft that I did with Tom Bowley and Grayson Rose a couple weekends ago. JBL is still a pretty good chart, I would say, still a decent chart. So within technology, again, a lot of vulnerable charts there, and a lot of charts that don't look particularly good. Other things I would note here, some areas of industrials that have been strong, particularly aerospace and defense, particularly highlighting GE, very close to a new all-time high today. Raytheon, RTX, teasing a new all-time high today. Howmet, HWM, making a new all-time high. Johnson Controls, JCI, breaking out here. So a number of names doing very, very well. Top performing industry group, by the way, the Dow Industry Groups was the airline group within the industrial sector. You can see Southwest Airlines not quite making a new closing high, but like very, very close to doing so. Delta, United, all sort of in that uptrend kind of phase. UAL is one that you want to see a breakout above resistance. It hasn't quite done that, but close. And then I guess the last observation on the heat map, and I feel like I'm stream of consciousness here today. Sorry for that. That's where my brain is after a long holiday weekend. I'm a bit scattered. The energy sector pulling back here. Again, like a chart like ConocoPhillips is still a very good chart. So let's keep in mind this is one day's trading. But the chart of ConocoPhillips, unfortunately, featuring a bearish engulfing pattern, right? That's a 2-bar pattern where you have an up day and a down day. Day 2 has a higher open and a lower close. So it's like a 2-candle pattern, right? Day 1 further upside, day 2 downside and distribution. So that tells you the next 1 to 3 bars maybe lower for ConocoPhillips. So bearish engulfing pattern there. You can see some other ones, and that's kind of classic bearish engulfing pattern kind of behavior here, kind of mid-December, right? 2-candle pattern, then you pull back for the next 3 bars. That's pretty it's a pretty common outcome after this particular type of pattern. All right, that'll do it for the heat map for today. By the way, next free webcast from Market Misbehavior coming up this Thursday, February 19th, 1 p.m. Eastern. Please forgive me for not getting out an announcement earlier. I am super happy to announce I've added a new marketing assistant to my team, and hopefully they will help me be better on top of these things because I'm struggling to manage all these awesome content things I'm trying to do. But but we're working on it. But please, if you can, join me for this free event. It's called The Calm Before the Turn, Late Cycle Sector Leadership. We're going to talk about these rotational themes that we've been covering. We're going to talk about the sectors that have been doing well in 2026. We're going to look at some models of what sectors tend to do well and tend to do poorly during different market phases. Talk about some observations about what that makes us think about right about now. You can sign up for that free event at marketmisbehavior.com/calm, CALM. There's a double speak there, a double meaning there. Calm, as in the calm before the turn, also calm, and our efforts to bring mindfulness and market awareness to our practice of analyzing market conditions. If you can't make that live webcast, by the way, just make sure you sign up for it. You'll be on the email list, and we'll send you an alert as soon as the replay is ready for your enjoyment. Again, sign up for that event this Thursday, the 19th, marketmisbehavior.com/calm. Let's finish off the show today looking at some charts. And again, we had the day off yesterday for President's Day, planning a regular schedule through the rest of this week. And thanks for joining me here today and all week, if you could. Trend in the markets. I mean, honestly, the trend in the S&P is sideways, right? And I'm saying that by the fact that we are at pretty much the exact same level now that we were around Halloween. We've kind of gone a little below current levels. We've gone a little above current levels. We've been in a range from around 6,550 on the lower end and 7,000 on the upper end for the last almost 6 months now. We've been within a shorter term range between 6,800 and 7,000 for the last 6 to 8 weeks. And honestly, you could probably go back to November for when we sort of initially entered this range, and then you just sort of have this rotation around that level. Look how the 21-day EMA and 50-day moving averages are almost dead flat right now. We're highlighting support just below 6,800. So in the very tactical time frame, that short-term level of 6,800 I think is important. We traded down to that today, but bounced higher, which is good. We break below 6,800. Next level we're watching, which is really the most important one at this point, thinking more about a medium-term time frame for me, would be 6,550. The 200-day moving average is right around those levels as well. This is what we call a confluence of support. If we do break down in the next couple days, that's where I would expect a next meaningful low, most likely a bounce off of that level, and then we need to reassess and see where we're at. The momentum has just been dead neutral for quite some time now. It was in a clear bullish phase really through mid-November, and then it's just been sideways. See how the RSI is going just back and forth between 40 and 60? That is the absence of strong momentum. That tells you buyers and sellers are in agreement. We are sitting on our hands as a market and waiting to see which way this resolves. For now, I don't think the chart is necessarily indicating a clear direction of what's coming next. But when you have this kind of sideways range, I think you set 2 alerts, right? Alert number 1, S&P over 7,000. That's pretty good. Alert number 2, S&P below 6,800. That's bad. And anything in the middle is still neutral. That's how I'm thinking about this short-term tactical time frame. The problem is short-term weakness, the longer it persists, can create some long-term issues, right? I was taught all large losses begin as small losses. So I developed a market trend model years ago to really just systematize my ability to define the trend in the S&P 500. So more broadly in the equity space in the US by looking at 3 different time frames. And I use weekly exponential moving averages to analyze this. This is the first chart that I review as part of my weekly flight plan for my Market Misbehavior Premium members every weekend. We start with this chart just as a way of setting the table for the meal we're going to have together in that video, and just set the table with what's the trend, right? Where are we coming from? What's happened up until this moment? And then let's talk about our expectations looking tomorrow. And so the short-term model for me turned bearish last Friday. I only update this once a week after Friday's close. Last Friday, our short-term model went below 0. That's a bearish rotation. We've had a similar short-term bearish indicator 3 times since the April market low. Every one of those previous times in mid-July, late September, and mid-November have ended up being pretty buyable dips on the chart of the S&P. That's some of these buyable dips that you see here in July, here in end of September, and then here in mid-November. So those are kind of the 3 kind of significant pullbacks within that uptrend phase. So is this more of the same? For now, too early to tell. If the short-term model would remain bearish this Friday, all of a sudden this looks a lot different than those previous 1 week only pullbacks, right? Those were brief pullbacks that immediately saw buyers come in. If we don't see dip buyers coming in, if that short-term model remains negative through this Friday's close, I would argue that probably means a much higher likelihood of a significant drawdown here in February and March. Medium-term model still remaining bullish, but getting very, very, very close to getting below zero. And that's been bullish since May of 2025. Last sort of sell signal or bearish signal we got from the medium-term model was at the end of February of 2025, which was just before that big decline into the April low. The time before that was here in the third quarter of 2023 with this signal that we were in a more significant pullback. So hasn't happened much, only 2 previous bearish signals going back to the beginning of 2023. So certainly something that would have my attention. We'll keep an eye on that as always and share any updates with all of you. Speaking of models that have me concerned right now, the Hindenburg Omen, I have to confirm, and we mentioned this recently on the show, but just to confirm, the Hindenburg Omen through last week, giving another confirmed omen signal. And what happens is you have 3 different factors. They all have to fire on the same day. And then the other part of it is you have to have multiple instances within 1 month where all the indicators fire and then they reset and then they fire again. Through last Thursday, I want to say that pattern was confirmed because you had a bunch of signals over a 2-week period. And so for me, that means the second time we've had a confirmed Hindenburg Omen in the last 6 months. We had one here in October into November, suggesting a major market peak. We've been sort of waiting for signs of a breakdown, and we haven't had it yet. But now we have another set of signals. So just once again confirms that the evidence we're seeing now with the market in a confirmed uptrend, with the breadth turning slightly negative, and that's using the McClellan oscillator, with new highs and new lows expanding, which is a key part of this indicator. That's now happened once again. And those are just very common occurrences. That combination of factors is very common at previous market tops going back for years and years. And so as a result, tells us to be skeptical of further market upside at this particular moment. We might put out another video on the Hindenburg Omen. It's been a little while since we did that last November. But if you have questions, of course, use the comment section on our YouTube channel. We're happy to answer questions on that powerful macro indicator. Again, in terms of longer term stuff, and this is something that I look at regularly. We don't talk a lot about on the show because this show is usually we're recapping what happened today, and then but as always trying to connect it to the larger picture. And again, the larger themes we're observing here are of leadership rotation and weakening price momentum, right? The pace of the advance of the S&P is non-existent anymore, right? Look at the uptrend. This is a weekly chart of the S&P. Look at the strength of the uptrend in April, May, June, July, August of last year, right? Just strong uptrend phase, minimal drawdowns. Compare that to what we see over the last couple months, which is really more, the line's going sideways, really, right? If you measure sort of the general trend in price. And it reminds me a lot of what we saw sort of, November, December, January here, end of 24, beginning of 25. Now that was before a major peak. Now something happened here in 2024. All these new highs were met with weaker MACD, or this is the PPO indicator. Saw the same thing in 2021 for about 6 months. We're making new highs on weaker momentum. And I would argue that's what we've been observing here over the last, 4 or 5 months, right? Going back to the end of September, the new, the attempts on the S&P to push above 7,000, which have failed so far, have been marked by the MACD indicator or PPO indicator here trending downwards, the weekly RSI sloping lower, so not confirming these most recent new uptrend moves. So between the Hindenburg Omen and these divergences, I would tell you what I'm seeing now as a technical analyst reminds me a lot of major market tops before the drawdown really starts to accelerate. Now, what has helped me get out of the way of major drawdowns after these signals has been focusing on those lines in the sand. That's why 6,800 in the short term, pretty important. That's why, from this daily chart of the S&P, that's why 6,550, incredibly valuable. Because as long as we hold that tells you these divergences are just divergences, but it's not the end of the world. Breakdowns of support, breakdowns of those lines in the sand. That's what can help you differentiate. Let's finish off looking at some individual stocks. These are names that I've been looking at here in the last day or two. I just wanted to highlight good examples to review with you. This is Corning, ticker GLW, throwback to Corning Glassworks, which was the previous the name that inspired that ticker GLW. Corning, a really interesting chart. Look at the breakout above 95, that gap. And then we had additional move higher, what we call a gap and run pattern, which is pretty encouraging. Nice follow through after earnings. This is a stock that reported earnings end of January. And from there, we gapped higher going into that earnings announcement. And then we see additional buyers coming in. That's kind of the sweet spot. That's kind of the perfect storm, I would say, for a company going into earnings. You see some optimism going into that release. And then after the earnings release, which clearly went pretty well, we see additional accumulation, right? Even after the earnings release, we have more and more people willing to pay more and more for that stock. That's how uptrends can be sustained for way longer than you think. Never confuse the top of the page with resistance. Just because a stock has gone up a ton does not mean it can't go up a lot further. I think being a trend follower pays the best in this sort of environment, just following that uptrend. I like the action we've seen going into earnings and then coming out of earnings. Chart of gold, we talked about last week a couple times, really noisy, pulling back here again today, as did silver. Newmont Mining is one of those gold names, which is sort of the largest one that people like to refer to. NEM for now is still okay. We broke below the 21-day EMA, and at the end of January, we had a couple hiccups below there earlier this month, but for the last week and a half, we pushed back above the 21-day EMA. I like the fact that it's holding that short-term level of support. I like the fact that the 50-day moving average is not broken. I like the fact that the moving averages are in the proper order and are continuing to slope upwards. As long as that continues, I'm going to say the chart is pretty good. I am watching the momentum though, right? As we've sort of continued this uptrend, the RSI is languishing here around 60. What we really want to see is a push higher on stronger momentum. So I think for Newmont, what you're looking for is the RSI pushing above 60 on a leg higher would be a really good confirmation of the current bullish phase. Concerned a bit about Dollar General. Two things that come to mind here. I'm going to toy with this chart just a touch. First would be the bearish momentum divergence as we're retesting those all-time highs around 155. The RSI is much lower. Look at the new highs in December and January with stronger RSI. Look at this attempted a new high here Friday into today, and the RSI much below the overbought region. So getting a bit of a bearish momentum divergence. Quick quiz. Do we know what this candle pattern is? Two candles. Day one is a big up day. Day two, slightly higher open. Give me the benefit of the doubt that that's slightly higher. It's almost identical. It's probably the same, but we'll give the benefit of the doubt and say it's slightly higher. We close at least 50% of the way, through the midpoint of that real body from Friday, but we don't get below the previous day's open. And as a quick comment, it's not a bearish engulfing pattern. That's this one back here. We have an up day and a down day, and day two, higher open, lower close. We closed below the open. That didn't happen here. We didn't get below the previous day's open. We actually are still within the range, but at least halfway through. This is called a dark cloud cover candle. The opposite in a downtrend, if you'd see that, would be called a bullish piercing line. This is kind of an example of that here. 2-bar candle, basically a short-term reversal pattern suggesting the next 1 to 3 bars is weaker. So that's bad news that we're seeing that on DG as it's threatening the previous all-time high. So here we had a shooting star candle as we made a new all-time high. We ended up pulling back soon after. Now we're having a dark cloud cover candle. Back here, by the way, we also had a bearish engulfing pattern. So it's like every time we've kind of pushed higher, we're getting these bearish candle patterns, and the next 1 to 3 bars end up being lower. So it looks like Dollar General most likely not continuing higher, at least for now, but we'll keep an eye. That's the candle look. Magnificent 7 names generally looking pretty unmagnificent these days, but Alphabet you can see breaking down through the 50-day moving average and continuing lower. If you think about what's changed in the month of February, at the end of January, even though some of the Magnificent 7 names like Microsoft and Meta were struggling, there was Alphabet making new highs. Even though the S&P and the NASDAQ were sideways at best, Alphabet's making new highs. And so I think, if you're using the yeah, but argument and you're bullish, right? Market, some things breaking down. Yeah, but Alphabet's still looking so good. How bearish do you want to be when Alphabet's making new all-time highs? Can't say that anymore, right? Alphabet's breaking down. Alphabet's below the 50-day moving average. The RSI is all the way down here around 30, which just means the general range of this momentum is down in the bearish range again. So could we get a counter trend bounce off of $300 a share, which is a big round number for sure? Does it mean something that is exactly where we bottomed out in mid-December? I think that's important too. So a counter trend bounce as we're oversold testing support, I don't think that's unreasonable. If and when, though, that does not hold, and if we break down through that kind of last line in the sand, that's where further deterioration, maybe down to the 200-day moving average, becomes a possibility. JPMorgan also testing key support, what we call a confluence of support. The 200-day moving average is just below Friday's low, right around 295. Look at all these lows, all the way going back here, right? Kind of have a pivot point around 295 to 300. That's pretty much exactly where we're at, going into today's session. For now, we're bouncing off of that support. This is after making a lower high about a week and a half ago. So we have a lower high. Now we're testing support. This chart is very close to a breakdown scenario that would make JPMorgan look like an ugly chart. It's gone from being an exceptionally good chart at the end of December to an okay chart as it's more sideways, but a bad chart is we start breaking through support. Key chart to watch. I'm going to set an alert for JPMorgan below 295, which would clear the 200-day and also clear those recent swing lows. Medtronic is another one. I meant to set an alert. I'm going to do that. I'm going to set it for a break below 96, which we did briefly do today, but we regained it a bit. Here's the swing lows from December and January. This is the lower end of this gap. So we've got gap support. We've got price support. We're kind of right at that level. So if this holds, could be a really good swing trade opportunity, maybe to retest the previous highs around 105. But if this doesn't hold, then I think we need to brace for further deterioration. Final chart of the day, T-Mobile US, TMUS, having a nice rally. What is that candle pattern? It's candle quiz day. I'm making that up. Wasn't planning it, but hey, why not? This is an uptrend. We have the open and close near the lows of the day. We have a long upper shadow and limited lower shadow. You could argue this candle 2 days ago, that's last Thursday, almost an identical candle, a little bit different, but still fits the definition of this candle. The real, I think, important part, though, is that this bearish candle pattern is happening as we test the 200-day moving average from below. So testing the 200-day from below with this bearish candle pattern tells me next 1 to 3 bars more likely lower for T-Mobile. Did you figure it out? Shooting star candle. I mentioned this earlier on, I forget whatever chart that was. Open and close near the lows of the day. Long upper shadow, limited lower shadow. Doing that right above the 200-day moving average basically implies we're going to get a bit of a short-term pullback, most likely, off of that 200-day, but all things forgiven and back to bullish if we can break above that 200-day moving average. Let's see if the momentum can remain strong. Folks, that'll do it for today. Thanks for joining me on a Tuesday after the long holiday weekend. Please keep your eye peeled for the Market Misbehavior podcast. Fantastic episode last week with Rob Hayworth, macro strategist at US Bank. And today recorded a great interview with Gina Martin Adams. That should be your way here very shortly, hopefully tomorrow. So keep an eye peeled for that as well. In the meantime, have a great evening. And remember, it's always a good time to own good charts. Take care, folks.